I am so excited to have Dr. Marc Faber with me, so well known throughout the world as a absolutely ace investor, commentator, the author of Gloom, Boom, and Doom Report. As I say, one of the best known investment analysts in the world. Marc, thank you for taking time. I appreciate it's early morning for you on Sunday in Thailand, so even more a big thank you.
It's my pleasure.
Let me start with, let's go to the stock market first for a second and just say in the U.S., for example, it doesn't matter what we throw at it, whether we throw Iraq or Ukraine or I still think a very, very tepid recovery at the U.S., it just keeps going up. And what do you think's driving it?
Well, basically what is driving stocks around the world to the upside is money printing by central banks. But I would like to put in perspective the performance of the U.S. market so far this year. And I'm talking about this year. We're up 7.42% on the S&P 500. On the other hand, the Sensex in India is up 25%. Jakarta, Philippines, Thailand, Pakistan, Vietnam are all up over 14%. The GDXJ, which is the Junior Mining Stock Index, is up 28%. So yes, stocks in the U.S. have performed well, but other assets have performed even better.
What message do you take away? I mean, we've also seen, though, as you mentioned, we're watching central banks, but we're watching them, sort of cut back on, the quantitative easing program. Again, is that something we should be attentive to? Is there a point at which you think that's going to have a greater impact on the market?
Yes, I think at some point it will have an impact, first of all, on the pricing of bonds, whereby this year long-term U.S. bonds have performed better than the stock market. They're still up 9% in terms of total return. But if the tapering proceeds, I suppose that at some point, A, the economy will weaken again, and B, that bond yields will first increase, which will then weaken the economy, in particular the housing market.
Interesting. Well, I mean, obviously we've been in this period of record low interest rates, and I think what people continue to kind of look at is, the Federal Reserve gives us hints they want it to stay there. The Bank of Canada said the same thing. Bank of Japan has been consistent in wanting to keep record low interest rates. I know it's kind of a lame question, but we do wonder how long they can keep them this low.
Well, on the short end, they can keep them for a very long time at artificially low levels. But obviously, one of the problems that I think will be forthcoming is the following. On the one hand, you have inflated asset markets. On the other hand, you have, as you pointed out in your opening remarks, still a weak economy, basically. And the more money they print, the weaker the economy, in my view, will become for the typical household, because the cost of living are rising more rapidly than salaries and wages. And so the more money you print, the higher asset prices will go, but it will be counterproductive for the economy, in my view.
And that leads perfectly into that sort of debate that we're having between inflation and deflation. I mean, you can certainly make a case stocks have been inflated, that certain property markets at least have, as you mentioned right at the top of the show, areas that have done very well. And then you've got the deflationary pressures that we're seeing. Are we finding an area where we're going to resolve to, sort of the inflationary side, or is deflation going to be the overhang, the fear in most areas of the economy?
Well, first of all, I think the public has been brainwashed that deflation is bad. You cannot cross the board say that deflation is bad. The entire expansion in the 19th century occurred amidst deflation. And during that time, 1800 to 1900, per capita incomes in the U.S., inflation adjusted, increased at a faster pace than in the 20th century when we had the central bank. So you cannot just say deflation is bad and inflation is good. In fact, I would argue that inflation represents an expropriation combined with artificially low interest rates of savers, and the money is then transferred to asset holders and to corporate profits. Monetary inflation is a tonic for corporate profits. And so when people say the stock market is not overvalued, that may be statistically to some extent true, although the valuations are high, but corporate profits are inflated as they were in 1929 and as they were in the financial sector in 2007.
Well, there's a couple things there that I want to come back and have you touch upon with Marc Faber here. And that is, let's start with the quantitative easing and that whole thing. While politicians love to talk populist talk and say, we're all for the little guy. I mean, it's embarrassing, actually, if someone wants to think for a minute. To me, there's absolutely no doubt that the policies that have been pursued in the last 5-6 years have not benefited sort of the average household, and in fact has made the rich richer, and as you say, have certainly bailed out the financial industry and the people working there.
Correct. And the question then arises, was the financial sector, or did the financial sector deserve to be bailed out? Because I don't think the world would be a poorer place without some of the big banks, without AIG, without Goldman Sachs, and so forth and so on. The financial sector today is disproportionately large to the real economy. And please explain to me what economic benefit, say, a derivatives trader in a bank brings to the world. Nothing. He trades against other traders, and then one bank makes money and the other one loses money and so forth. But nothing really has been added to the world's GDP or to global economic growth. So I think that actually the financial sector, this expansion of the financial sector and the asset inflation in bonds and stocks has had a rather negative impact on the growth of the typical household or on the growth of the real economy, not the financial economy.
Well, in fact, we watch savers absolutely be punished. They're punished through their pensions, and they've obviously punished through their bank accounts and other aspects. It's been, we just rarely talk about that side of the equation, I think, because it's politically inconvenient,
This is the unpleasant truth, is that what the Fed and other central banks have created is a nirvana for financial people like myself. And I'm self-critical. I would never have made the kind of money without money printing that I have.
Yeah.
But if I look at the world as an economist, I think it's not right.
I'm talking with Marc Faber, Gloom, Boom, and Doom Report, one of the best-known investment analysts in the English-speaking world, joining us live from Thailand. I'll come back. I'm going to ask Marc, let's get to gold. Let's get to the markets and what you should do individually, the kinds of overview that he can lay on us and about our money with Marc Faber. Thrilled to have him with us here on Money Talks right across the country on the Chorus Radio Network. A great pleasure to talk to one of the great names in the investment business, Dr. Marc Faber, author of best-selling book Tomorrow's Gold, and of course best known right now as the author of the newsletter, the Gloom, Boom, and Doom Report. Easy to get to, by the way, if you just go gloomboomdoom.com. It's all there, all sorts of stuff, and talks about a variety of issues. There's never enough time, so I'm just going to start firing the questions to Dr. Faber. Marc, let me just go to some of the specific investment markets, come back to something you started with, but generally, and I know this is very broad brush advice. We don't know everyone's individual circumstances, but just broad brush advice about, say, the U.S. market.
Well, basically, the U.S. market made a low in March 2009 at 666 on the S&P. We're close to 2,000. We've been moving up 3 times. Since October 2011, in other words, now soon 3 years, we never had a larger than 11% correction. I think it's not a good time to buy U.S. equities.
Do you have a favorite stock market when you look around the world for investors if they were going to initiate positions?
Well, in this money printing environment, everything has been inflated. But I would say we had a big bull market in gold, 1999 to September 2011. We've come down around 40% to 1180. And I believe that we are now again rallying. And so gold, physical gold, platinum, silver, palladium, and especially gold shares are a sector that is relatively attractive in my view. Then we have Vietnam that is relatively attractive. And I think that if the Chinese economy worsens, China will also print money like they did elsewhere, and then we get a bounce in Chinese stocks, which would be beneficial for Hong Kong shares. In general, I don't think that Hong Kong shares are terribly expensive, and many property companies in Hong Kong are selling at an approximately 40% discount to net asset value.
Wow.
I'm not saying that they are selling that the net asset value is the right net asset value. I think property prices may come down somewhat, but I think that the stock market has already largely discounted a decline in property prices.
Let me come and ask you to elaborate in a few of those because, in Canada, of course, resource stocks play an important role. We've seen the gold stocks beaten up far more than the metal itself in the decline.
Sure.
So, so I just want you to elaborate a little bit. I mean, are we talking the senior golds? They have to be producers. That's going to be the beneficiary at first over time. And you're not talking about a short-term trade here.
As I mentioned, the junior gold index is up 28% this year. Mm-hmm. And some small gold mining companies are up actually 50 to 100% already. Now, if the gold price continues to go up, I think the large mining groups like Barrick and Newmont will also move because of the high leverage. So a rising gold price, and especially if copper recovers somewhat, would be very beneficial, and they could perform reasonably well. But in general, I prefer physical gold, and the commodity I think that looks fundamentally most attractive is platinum.
Okay.
But I mean, I just want to mention Eric Sprott, who is a friend of mine, and I sit on Sprott Inc.'s board, and they're a large manager of principally metals companies, mining companies, and these physical trusts, platinum, palladium, gold, silver. He sold shares in his company, in other words, in Sprott Inc., to buy shares in junior gold mining companies because he thinks that if there is a bull market or the renewed bull market in gold, will lift the shares of Sprott Inc., maybe by 50%, maybe by 100%. But he thinks that in junior gold mining stocks, you can make maybe 10 times, 20 times your money. So I think there is some merit for the more risky money that you have to buy again these small mining companies.
It's interesting. Whenever, as you mentioned, though, some have already had a pretty good bounce, and then the people start going, should I wait for a correction? Should I not? They play that crystal ball game, and a lot of times end up missing the move because of that.
Yes. I'd just like to also add to this. We basically had a move this year. We began the year below $1,200. And then we rose on gold, to $1,392 in March of this year, and then we fell again to around 1241, and now we're around 1320. So on this latest rally from 1241 to the current level, we have had widespread bearishness among gold market timers and among people, advisors, who said, oh, this is a fake rally, it will come down again. So I'm encouraged actually by so many people having missed this market move, because it means that if the gold price indeed comes back down again to around 1250, there's going to be some buying.
Yeah, I would agree. And come back. Let's come back very quickly here. I don't want to be running out of time, but interesting your comment about platinum. You think that will outperform? Do you think silver's going to outperform gold, or who cares? You just sort of get involved.
Well, you know, it's very tough to tell, because there are times when gold outperforms silver and vice versa. Platinum has some unusual fundamentals, in the sense that most of the production is in South Africa and in Russia. And so it is more vulnerable to supply interruption than gold. It's also less of an investment market than gold. So I think for now, platinum looks actually quite attractive.
Yeah, I'm with you. And just to finish off here, if you can give a comment on currencies, whether it's the U.S. dollar, the Canadian dollar. I mean, everything hinges off that U.S. dollar, but a quick comment on that.
I think maybe anything is better than the U.S. dollar.
Okay.
No, I think that's unfair to say. The dollar should strengthen here. But my surprise is how weak the dollar has been, given the decline in the current account deficit, given the prospect of oil and gas self-sufficiency and so forth. So I'm wondering, why is the dollar so weak? It should be actually much stronger. Now, can it strengthen meaningfully? Maybe by about 10% against the euro, but I wouldn't bet on it.
Yeah. Because
the Fed, in my view, has zero, and I repeat, zero interest in a strong dollar.
Interesting as always. Marc, I want to thank you for finding time. I know it's very late at night for you, but boy, is it ever a pleasure to get a chance to chat.
Well, thank you very much for calling me.
Well, great stuff.
I wish your viewers and listeners happy weekend.
Well, thank you. Just go to gloomboomanddoom.com. gloomboomdoom.com. Dr. Marc Faber, great stuff. I got to take a break. I'll come back. I'm going to be doing my shocking stat of the week. And just by the way, Dr. Faber mentioned Vietnam stocks, for example. You do that through exchange-traded funds. You can just Google them and ask, well, in Vietnam, there's one that's attached to the index. The symbol is V as in Victor, N as in Nigel, M as in Montana, VNM. That's the ETF for the Vietnam's stock market. Come back with a shocking stat. Got it.